In today's video, we will talk about two very important attributes of stock market, which is ROCE and ROE, return on capital employed and return on equity. So let's say you have built a company which is known as A. Okay, you have total 500 rupees of equity with you, and let's say you have raised some money or you have taken some debt or loan which is of 500 rupees. So how much money in that case you have raised, which is your equity, which is 500 rupees, which is already with you, and debt of 500 rupees, right? Let's say for a certain period your operating profit is 300 rupees and your net profit is 200 rupees. Now let's understand how we will calculate the ROCE and ROE. So ROCE, R stands for return and OCE stands for on capital employed. What does ROCE exactly mean? ROCE means how much money are you making on your capital employed. So how much money basically you are making, or you're having a profit on your total capital employed. What is your capital employed? Capital employed is nothing but your equity plus your debt or loan. Okay, so here it is 500 plus 500 equals to 1000 rupees. So this 1000 rupees is your capital employed. Okay, what is the return you are making on this 1000 rupees? So remember a thumb rule for ROCE, we will always consider return as operating profit. Okay, so your operating profit here is 300 rupees. So your return becomes 300 rupees. So basically this 300 rupees you have earned extra on your capital, which is 1000 rupees, right? Then your ROCE will be return, which is the operating profit on capital employed. So which is 300 by 1000 into 100, which will become as 30%. So important takeaway that for ROCE you will only consider operating profit, right? That will give you the clear picture on the ROCE. Now let's come to ROE. ROE stands for return and OE stands for on equity. So what is the equity amount only? This is 500 rupees, right? So that means on this 500 rupees, what return have you made? Right? So your return, we will always consider net profit for ROE. So it is 200 rupees. So that means your return on equity is basically 200 on 500. So your 200 becomes your net profit and equity portion is only 500 rupees. So it becomes 40%. Now basically what does it mean? So ROCE is return on capital employed and ROE is return on equity. So let me give you a very simple example. Let's say you have a company known as A. So you have total 500 rupees of equity and you have taken 500 rupees of debt. So that means 1000 rupees. And at the end of the day, with that 1000 rupees, let's say you have earned total of 1300 rupees, right? So additional 300 rupees, whatever you have earned, that is your profit, right? So that becomes your operating profit. So that 300 rupees extra you have gained on that 1000 rupees. And on 200 rupees, which is your net profit, let's say 1300 rupees you have earned, and then you have given your interest on your debt, okay, and then tax and other expenses. So that will become your net profit. So that means 200 rupees, that means 1200 rupees you have earned on 1000 rupees. It was your initial investment, right? Which was equity plus debt. But when we will be calculating ROE, so we will check on equity how much money you have made. So you have made extra 200 rupees because your total earning is 1200 after your all the tax and interest, which is actually your net profit, right? 200 rupees. So 200 rupees on 500 because we will calculate ROE on equity only. So your net profit is 200 divided by 500, which will become 40%. Always remember that when to consider ROCE and when to consider ROE. Okay, the companies which are debt free, you always consider ROE. Okay, because there is no debt portion, right? Debt is zero. So ROE will give you a better picture. And the companies with debt, you always consider ROCE, because with debt, if you consider ROE, then it will give you a wrong picture. It will give you not the correct insight of that company, right? So whenever a companies are having debt, always consider ROCE, and whenever a company is debt free, always consider ROE. Now you might ask, what is this equity? So whenever you will go to any screener or any website, you will see that on the balance sheet there will be one thing called shared capital and one thing called reserves. So the summation of shared capital and reserves is known as equity. Okay, so that is the take on ROCE and ROE today in today's video. So please consider before investing in any stock to understand the ROCE and ROE. Just go and invest, and try to invest more in high ROCE and ROE stocks, because they give better returns in terms of your stock market movements, right? So I hope you have enjoyed today's video. In case of you need to understand such topics, very important topics, in a simple language, so you can definitely comment. So if you have liked this video, please do like and subscribe my channel. Thank you.